Yo, I'm Brandon, and today I'm going to explain exactly why it takes forever to pay off debt, like student loans, credit card debt, your mortgage, all those things. It's so counterintuitive whenever you look at how much money you're paying every single month. Like for us, our mortgage is $1,500 a month. We're paying this every single month, and yet we still owe tens of thousands of dollars on this house that I'm in right now. How is it possible that you can be paying on your student loans for 5 or 10 years and still owe so much money? It's totally ridiculous, and here's exactly why that is. For today's example, let's use the average student loan balance and term and rate. The average student loan right now is $37,853, and the term that you have to pay that off is 20 years. It would be really nice if it was as simple as saying, okay, I've got a loan balance of $37,000 divided by 20 years. That means I'll have to pay like $1,900 a year, right? If that was the case, my payment would be like $157 a month. I'll pay it off and I'll be able to see this nice clear path of the progress I'm making. That's not how it works. It's the opposite of that. And the reason for that is this pretty little number here. The average interest rate on a student loan right now is around 7%. And it's not enough that the lender is going to make that 7% on your loan, because what they want to do is make sure that they make as much money as soon as possible too. They're not going to make it equal between you and them. It's not equal. We are under the boot of that person who's loaning us the money. And so they're going to make sure that they get all of their money as early as possible. To really understand what that looks like, we can break this down year by year and see how this works. Because whenever we first take this loan out, we owe that full balance. And we're making a payment of something like $300 a month. $293 per month is your payment. So you think, okay, that loan balance is going to be chunked down by $200-300 a month, right? Wrong. If you took that loan out today, these first few payments you make at the end of this year are only paying off $73 per payment out of that actual loan balance that you owe. The rest of that payment, $220 a month, is going straight into their pocket. The lender who you borrowed the money from is front loading the repayment of their own loan. In the early stages of paying off a loan like this, 70% of your payment goes towards them getting their money back, and only 30% of your payment actually goes towards paying off your balance. Even after a year of paying this, you're only getting $77 or $78 a month going towards your actual balance that you owe, and still $215 per payment is going towards them making their money, making their profit, getting paid back for that initial money that you paid them. Check this ridiculous thing out. It takes 10 years of you making payments on this loan for that payment to be equal parts. So that means you're paying off an equal part of your loan at the same rate that you're paying them back their money. 10 years later, you're at a disadvantage for that long. It's totally ridiculous. Finally, in the very last year of your loan, 20 years later, you're getting $285 of that payment actually going towards paying off your loan, and only $10 is actually going into their pocket. When they do that and they prioritize their own money getting sent back to them, and they don't prioritize you actually paying off your loan, and they put it in this kind of format, it's called an amortization schedule. It's a big, nasty, ugly word that just means they're going to win as fast as possible. Because in their mind, what happens if you default on your payments 5 or 10 years in? What happens if all of a sudden you can't make as much money as you used to, and maybe you have a hard time making these payments? Well, they're not going to miss out on their money. As borrowers, we're the kind of people that need their help. We went to them. We asked them for this money to buy the house or the car or the student loans. And so we're at this massive disadvantage whenever we borrow money. The only way to get out from under this, once you've already got the loan secured, once it's too late and you've taken out the money, is to pay it off faster. You can make extra payments. For some people with their mortgage, that's just one extra payment per year, or you can make an extra payment however often you want. The trick is, if you're going to do that, you need to make sure that whenever you're filling out that payment form, you're specifying that you're paying towards principal only. So you'll have to have like made that payment for the month. Then on top of that, send them more money that's strictly towards the principal. Principal is paying off the balance that you owe. If you don't do that, you run the risk of just prepaying the next month and not actually saving yourself any money. As long as your loan doesn't have a prepayment penalty, which means you're not allowed to pay it off early, then paying it off sooner than expected saves you money and interest. If you run this whole thing out and you pay the minimum amount and it takes you all 20 years to pay this off, you would have paid $32,000 in interest. And you only borrowed $37,000 to start with. So it almost doubles the overall amount of money that you thought you were borrowing. The total cost of you borrowing $37,000 is $70,434. You can get around that if you make extra payments towards your principal right off the bat. As early as possible, making those extra payments will save you a bunch of money in interest, especially if you've got a higher interest rate. This is compounded with credit cards or payday loans or anything with an interest rate over 7 or 10%, because that's where you're really getting absolutely massacred by by that interest. To reach financial freedom, you've got to pay off your debt, but you've also got to grow your money. You've got to learn how to invest and save and manage your money in a way that makes it compound over time. And so if you want to learn more about that, watch this video next where I talk about how to invest your money, how to make it grow. Paying off debt is good to get out of the hole, but multiplying our money is even more exciting. So watch this video next. Thanks for watching. I appreciate you guys, and I'll see you later. Bye.